Welcome to Don't Use Finance Research, a finance growth channel that hopes everyone can get wealthy. Today, the book we're doing a close reading of is The Creature from Jekyll Island. Let's start with a question that's easy to take for granted. When you hear the Federal Reserve, is your first reaction that it's a bank run by the US government? After all, it has federal in the name, which sounds official. The news always says it manages the US economy and sets interest rate policy. Over time, we just assume it serves the American public. But the author, Edward Griffin, lands a heavy blow to our assumptions right at the beginning. He says the Fed is neither federal, nor does it hold real reserves, and it's not even a bank in the traditional sense. That sounds pretty disruptive, right? Don't rush to object, let's follow the author and unpack a small detail. Have you ever seen a government bank that was quietly designed by Wall Street titans? In the winter of 1910, on Jekyll Island, Georgia, 6 men who brought no staff and used aliases held a secret meeting. There was Senator Aldrich, J.P. Morgan's business partner and the Rockefellers-in-law. There was also the president of New York's National City Bank, a representative of the Rothschilds, and others. This group, who controlled a quarter of the world's wealth at the time, hammered out not a plan to stabilize the economy, but a set of banking cartel rules in a private villa: how to grip small banks' reserves in their hands, how to make taxpayers foot the bill for bad debts, how to hide a private monopoly under the banner of a central bank. Even more interesting, the Fed was sold to the public with slogans like "prevent bank runs" and "stabilize prices." But the author digs up historical data to puncture that: the 1929 Great Depression, the sky-high inflation of the 1970s, the 2008 financial crisis. Which of these didn't have roots in the Fed creating too much money or mismanaging policy? Take the 1970s, ordinary Americans watched the purchasing power of their savings shrink year after year, while banks, thanks to the Fed's low-interest loans, made out like bandits. How is that stabilizing the economy? It's harvesting the middle class. Today, our close reading isn't to memorize jargon. It's to strip the Fed's disguise. Whose tool is it? How does it create money out of thin air to turn debt into wealth? And why is it called the biggest mystery story in modern financial history? Next, let's start with that secret meeting on Jekyll Island and get the Fed's origin straight. To understand a monster, you first need to know how it was made. To understand the Fed, we have to return to a key moment before its birth, that winter of 1910, which changed America's financial landscape. Many people think the Fed was set up by the US government to stabilize the economy, natural and proper. But Griffin shows with abundant evidence that it wasn't a blessing from on high. It was a product of financiers conspiring in a closed room, with the core aim of monopolizing the right to issue money and controlling the lifeblood of the US economy. Let's focus on the famous Jekyll Island meeting. The island was a private resort for the super-rich, so secluded even reporters struggled to get near. In November 1910, 6 men with unusual status boarded a yacht bound there. Curiously, they used aliases the whole time, pretended not to know each other, and even their servants didn't know their employers' real identities. Who were the 6? All top of the financial world at the time. Leading was Republican Senator Nelson Aldrich, a politician, yes, but also a key partner of the Morgan interests, with a daughter married into the Rockefeller family. Along came Frank Vanderlip, president of National City Bank of New York, the Rockefellers' purse. Also Henry Davison, a senior Morgan partner, and Paul Warburg, the Rothschilds' agent in America. In short, the forces behind them controlled over 90% of America's railroads, steel, and finance, holding a quarter of the world's wealth. Why meet in secret? Griffin quotes a participant's memoir: "If the public knew what we were discussing, panic would ensue, so secrecy was essential." They weren't discussing how to protect ordinary depositors, but how to fuse all America's small banks into one great vault, forcing everyone to play by their rules. At the time, there were tens of thousands of local banks fiercely competing. When the big trusts wanted to lend, small banks might steal the business. If a big bank had bad debts, small banks wouldn't bail them out. These magnates had long wanted a banking cartel, like oil barons monopolizing prices, monopolizing lending rights and interest rates. The meeting lasted 9 days and produced a core plan later called the Aldrich Plan. Forget the fine print, 2 points matter most. First, concentrate all small banks' reserves into 12 regional Federal Reserve banks. Small banks wanting to lend would have to bow to the 12, cutting off their autonomy. Second, when banks face trouble, big banks mustn't lose money, the government should step in to backstop them in essence, using taxpayers' money to insure the big trust's risks. Griffin says this wasn't reform, it was wolves writing rules to protect sheep and the sheep paying for it. A plan alone wasn't enough, how to fool Congress and the public. The magnates donned disguises with skill. First, they changed the name. They were building a privately controlled central bank, but avoided the term central bank, choosing Federal Reserve System instead. Federal made people think government. Reserve sounded like real gold behind it. System sounded professional and decentralized, masking private control. When some legislators asked if it was public or private, they pointed to the 12 regional banks' power spread across the country, not one giant. In reality, the heads of the 12 were all selected by Wall Street insiders, their own people. Next, they built a myth: the Fed could stabilize the economy and prevent bank runs. They cited past mini crises and claimed that if a Fed had existed, they wouldn't have happened. Griffin slaps that down with history: the Great Depression of 1929, the 1970s inflation, the 2008 crisis, each larger than pre-Fed panics. In 1929, before the crash, the Fed printed money wildly, inflating a huge bubble. After the crash began, it abruptly tightened money, bankrupting firms and families. That's not stabilization, that's detonation. Ironically, critics of the plan were labeled as ignorant and anti-progress. With media they controlled, the magnates smeared opponents as backward while praising the reserve plan as a cure-all. Finally, in 1913, just before Christmas, while many lawmakers had gone home, Congress quietly passed the Federal Reserve Act. The Fed was born. Ordinary people never knew that their economic lifeline had been placed in a few hands. At this point you might ask, why go to such lengths to create a disguised bank? The answer lies in money itself. Whoever controls the issue and circulation of money controls the nation's wealth. Next, we need a quick crash course in money, its nature and types, so we can see how the Fed later used money creation to build a monopoly and harvest wealth. If you don't grasp money's logic, you'll never spot the Fed's tricks. We've said the Fed was plotted by financial titans. You might ask, to what end? Griffin answers: control over money. To grasp how powerful that is, we need a money crash course. If you don't understand money's essence, the Fed's money-making schemes just look complex, while the trick remains hidden. First, distinguish 4 kinds of money, the foundation of everything. Griffin uses everyday examples to make them crystal clear. 1. Commodity money, the most tangible: gold, silver, shells, grain. These work as money because they have intrinsic value, with no one's promise required. A piece of gold is accepted anywhere that values gold. Supply is limited, you can't print it, so it resists devaluation. Griffin calls it the most honest money. 2. Receipt money, think of a goldsmith's claim check. People deposited gold for safekeeping and got a paper receipt. Trading the receipt was easier than hauling gold, later you could redeem it. The key: there must be real commodity backing it. Without the gold, the paper is worthless. 3. Fiat money, what we use today, like dollars or yuan. Government declares it money by law, there's no commodity behind it. Its value rests on legal tender laws and public trust. Easy to circulate and to manage, but if overissued or trust erodes, it inflates. In war or chaos, governments print wildly, soon a sack of cash won't buy bread. For reserve-based money, fractional reserves, the something-for-nothing game banks play, core to the Fed's trick. You deposit 100, the bank keeps, say, 10 as reserves and lends 90. The 90 gets redeposited elsewhere, 9 kept, 81 lent, and so on. Your original 100 becomes 1,000 of loan money. Griffin calls this money creation out of thin air. Different types mean different room for manipulation. Commodity money is hardest to game, receipt money is safer if backed. Fiat and reserve money are easiest to manipulate. Whoever controls the printing press and sets reserve ratios can conjure money and thus control the economy. Griffin stresses, gold matters not for its glamour, but because it restrains power. Limited supply means governments and banks can't create it at will, curbing endless printing. Before 1971, the dollar was tied to gold. Printing more dollars required more gold, imposing discipline. After Nixon severed the link, the dollar became unanchored fiat. The Fed could create it while seeding later inflation and crises. He gives counterexamples. The Continental during the colonial era, no gold backing, printed at will, soon became nearly worthless. People preferred barter. In late Rome, emperors kept reducing the silver content of coins, money collapsed and the empire followed. Once you grasp the four types, the Fed's operations become clear. Next comes the Mandrake mechanism, how the Fed pushes fiat and reserves to the limit, buying treasuries to conjure base money, using reserves to multiply it, turning debt into wealth and quietly skimming savings. Having understood the four types, let's break down the Fed's core money-making routine, the Mandrake mechanism. Griffin calls it modern alchemy. It creates money from nothing and turns government debt into bank wealth. We'll use a home loan example to make it simple. The essence: turning debt into dollars. Step 1. The government needs money for roads or benefits, so it issues treasury bonds, IOUs promising to repay with interest. Step 2. The Fed buys those bonds, but not with existing funds. It writes a check with no backing. If the Treasury sells $10 billion of bonds, the Fed writes a $10 billion check. Treasury deposits it in a commercial bank, and poof, new dollars exist to spend. The core trick: that Fed check is backed by neither gold, nor savings, nor the Fed's own funds. It's conjured numbers on paper, creating real purchasing power for the government. Step 3. Banks do secondary creation via fractional reserves. With a 10% reserve ratio, $10 billion in new deposits allows $90 billion in loans, which become deposits elsewhere, allowing more loans, and so on. The initial $10 billion becomes roughly $100 billion of loan money. Griffin's math: at 10% reserves, each dollar of base money can spawn about $10 of broad money. The source is that original Fed empty check. Where's the risk? Not with the Fed or big banks, ordinary people pay. Griffin cites 2008, banks made loans to people who couldn't repay subprime. When defaults hit, mortgage securities went bad. By normal logic, banks should eat the losses. Instead, the Fed rescued them, firing up Mandrake again, creating new money to buy bad assets and offering zero-rate loans. Banks survived, executives kept bonuses, the new money stoked prices, ordinary people's cash lost value, the inflation tax. More chilling, under Mandrake, each dollar is born from government debt. To repay the Fed, government must tax more or issue more bonds, creating a vicious cycle: more debt, more money printing, weaker dollars, heavier burdens, explicit taxes or stealth inflation. Griffin argues Mandrake doesn't manage money, it plunders wealth, siphoning savings from the public to bankers and the state. With Mandrake understood, American monetary history makes sense: why the first 3 central bank attempts failed, and why the Fed survives: because it hid the monopoly better. Griffin devotes a large section to America's first 3 central banks, not for padding, but to show the Fed wasn't the first try. The first 3 fell because private monopoly was too blatant. The Fed learned to hide it. First Bank of the United States, 1791. The young nation was debt-ridden. Hamilton pushed a central bank to manage debt and issue money. The structure raised eyebrows: government owned 20%, 80% was private, including foreign capital from Britain and Holland. Soon it manipulated money, deliberately contracting supply so farmers and small businesses couldn't repay, forcing asset fire sales. Insiders scooped up bargains. Jefferson warned, handing monetary power to foreigners undermines the nation. In 1811, its 20-year charter expired. Congress narrowly voted it down. Lesson: private monopoly and foreign ties trigger backlash. Second Bank, 1816. After another war and fiscal chaos, Congress tried again, same 20/80th split, private power intact. It went further, manipulating money and meddling in politics, backing Jackson's opponent in 1828. Jackson pulled federal deposits, starving it of funds, calling it a monster enriching the few while impoverishing the many. In 1836, its charter lapsed, dead. Lesson: blatant political interference crosses a red line. Later, the national banking system, 1863, allowed private note issuance backed by government bonds, so money supply tracked bond issuance. Big banks buying more bonds gained issuance power, small banks trailed, the public suffered. The 1907 panic exposed flaws and opened the door to the Fed. The Fed's cleverness, it fixed the earlier fatal optics. It didn't call itself a central bank but a Federal Reserve System, sounding like a government coordinator. It created 12 regional banks, power decentralized on paper. In reality, Wall Street recommended the leaders, government rubber-stamped them. New York Fed, running operations like bond buying and rate moves, has long had outsized clout, its president often the de facto number two, sometimes more influential than the chair. It had private control by limiting stock to member banks, with low, non-transferable dividends looking like an obligation, not a profit play. But member banks, via control, get cheap funding and priority business, long-term gains dwarf dividends. Griffin quips the Fed wears a government coat over a private banking core. The first three banks die for overt plunder, the Fed lives by covert control. But the essence remains, the few wield monetary power for themselves. Now, let's reckon the ledger. What has the Fed actually delivered? Did it stabilize the economy and protect the public, as promised? In 1913, the Fed promised three things: stabilize the economy, prevent crises, and protect the currency's value. Griffin's century-long accounting is startling. The Fed became a maker of turmoil, a driver of devaluation, and a tool of wealth extraction. First, stabilization. Before 1929, the Fed slashed rates and expanded money, inflating stocks and real estate. From 1928 to 1929, market value more than doubled, ordinary people borrowed to speculate. Then, at the peak, the Fed tightened abruptly, cutting off bank liquidity, triggering forced selling, collapse, and depression. Research suggests that without the sudden tightening, the Great Depression might have been half as severe. In 2008, years of low rates encouraged subprime lending and securitization. When defaults hit, the system imploded, taxpayers paid. The Fed, as regulator, didn't warn early and became an accomplice. Second, protecting value. In 1913, $1 bought about 0.888 grams of gold, $100 could buy a cow and a couple of acres. By 2023, a dollar's purchasing power was under 5% of 1913's, $100 won't buy half a bag of flour. Post-1971, unanchored dollars let the Fed print at will. QE after 2008 created trillions, the 2020 pandemic added nearly $3 trillion more. Prices climbed, wages didn't keep up. The hidden tax of inflation shrank savings while assets owned by the wealthy, stocks and property, soared. Third, fairness. The Fed supposedly serves the public but functions as a privilege machine. Big banks never fail. In 2008, Citi and B of A were rescued with cheap loans, bad asset purchases, even capital injections. Nearly 500 small banks failed, left to die as non-systemic. Big banks are Fed shareholders, small ones are expendable. Fed policy widens inequality, the rich hold assets that rise with inflation, the poor hold cash that erodes. From 1913 to 2023, the top 1%'s wealth share rose from 18% to 40%, the bottom 50% fell from 20% to under 2%. Another fatal issue: the Fed is a war enabler. Every U.S. war has relied on its money creation, World War I and II, the Cold War's proxy wars, because war justifies massive bond issuance, the Fed buys bonds, bankers earn fat interest. Griffin quotes the Rothschild maxim, "If I control a nation's money, I care not who makes its laws." No wonder Griffin says the Fed should be ended. If it were ended, what next? What would replace it, and how can ordinary people protect wealth? Griffin offers two trajectories, not predictions, but extensions of how the Fed cycles from money creation to debt to extraction. First, the darker path, debt crisis and runaway inflation. U.S. federal debt has surpassed $36 trillion, over $100,000 per person. The loop: issue new debt, the Fed prints to buy it, pay old with new, has a fatal flaw. If markets doubt the dollar or foreign holders dump treasuries, the system breaks. More issuance means more printing means faster devaluation, foreigners sell treasuries and use other currencies, like more oil settled in yuan or euros. To attract buyers, rates must rise, raising borrowing costs and forcing households and firms into painted stagflation. If the dollar loses reserve status, the U.S. can't print to buy the world's goods, prices surge, living standards drop. There's also systemic risk: banks stuffed with risky assets thanks to years of easy money, commercial real estate, leveraged derivatives. If the Fed hikes to fight inflation, as in 2022, those assets fall. 2023's Silicon Valley Bank failure was a warning: bond losses, depositor runs, collapse in days. Without a new model, more failures could come worse than 2008, threatening deposits. Second, the hopeful path: public awakening and reform, not violent overthrow, but pressure to change the monetary order. The Fed's best shield isn't law or government, it's public ignorance. If people learn that inflation comes from printing, they'll oppose endless QE. If they learn bailouts socialize losses, they'll demand limits on executive pay and allow failing banks to fail. If they learn post-1971 dollars constantly depreciate, they'll hedge with gold and silver, nudging discussion of re-anchoring money. Some U.S. states, e.g., Utah, Arizona, have taken steps to recognize gold and silver. There are calls to audit the federal. The aim is to reallocate monetary power to the people, re-anchor currency, gold/commodity standard, curb the Fed's printing, decentralize banking, enhance transparency and oversight. Whether the darker or brighter script unfolds, one thing is certain: the Fed's current model is unsustainable. The debt inflation mines will blow sooner or later. The choice is to suffer later or act now. For us, understanding this isn't to predict dates, but to protect ourselves, handle inflation, choose safer vehicles, avoid being harvested. We didn't study the creature from Jekyll Island to wallow in conspiracies or complain, but to find practical defenses. Griffin's advice: build a wealth firewall with 3 actions. First, update your mindset. Don't equate saving with safety, make beating inflation the goal. Cash is the fastest depreciating asset under endless printing. Instead of all deposits, allocate a portion, say 20%, to inflation hedges like gold, including small ETFs, and quality real estate or REITs. Second, diversify. Crises vary: stocks, housing, currency. A simple thirds approach works: 1/3 cash for expenses and emergencies, 1/3 in defensive assets like treasuries/IG bonds, 1/3 in growth quality equities/index funds. Whatever happens, inflation or deflation, part of your portfolio can withstand it. Third, watch monetary signals, don't be hypnotized by jargon. QE equals printing, hikes equals costlier debt for households. 2 Qs: when the Fed expands its balance sheet, buys bonds, brace for inflation, hold less cash. When it hikes, be cautious with leverage, don't binge on loans for houses or stocks. Skim Fed releases for key data, trust your own judgment, not sure when pitches. Griffin didn't write to make us anxious, but clear-eyed. The Fed's power can't override rational planning. Don't chase fads, don't crave high yields, don't cling to false safety. Fight inflation, manage risk into your financial habits. There's no savior in finance. The one who sees through the logic and acts rationally is the one who avoids the shears.